Hello everyone, John AG here. Welcome back to my channel, Aurex. If you haven't yet, subscribe to my channel. In this channel, you will find the real information, real market updates that everyone cannot tell you. So please subscribe this channel and love you all of my subscribers for your support. And please watch this video till the very end because YouTube will not push my videos to more people. And you need to watch until the very last second today because what I am about to share with you is not just another market update. It is not a speculative theory. It is a mathematical, historical, and deeply human reality that the mainstream financial media is either too blind to comprehend or too terrified to report. We are standing at ground zero of a global financial earthquake. For the last half-decade, a silent, invisible, and unstoppable force has been steadily hollowing out the very foundation of the modern technological and financial world. They told you there was plenty of it. They told you the vaults in London and New York were overflowing. They told you the digital numbers on your screen were an accurate reflection of physical reality. They lied to you. Today we are going to tear down the veil and expose the greatest illusion of the 21st century commodity markets. We are going to dive deep into a terrifying yet profoundly lucrative phenomenon that I call the silent silver tsunami. We will uncover exactly why global inventories of the world's most critical, most essential, and most entirely misunderstood precious metal are rapidly vanishing into thin air. By the time this video is over, you will understand with absolute clarity why the violent price spikes we saw earlier this year, when silver briefly touched all-time highs above $121 an ounce in January 2026, were not an anomaly. They were not a glitch in the matrix. They were a tremor, a brief, violent warning before the true tsunami makes landfall and sweeps away a century of financial engineering. Grab a seat, turn off your phone notifications, close your other tabs. If you have ever wondered how wealth is truly preserved when empires transition, you are going to want to absorb every single word of this. To truly understand the sheer magnitude of the crisis we are facing right now in May of 2026, you first have to understand the psychological illusion we have all been living under. We exist in a hyper-financialized, digitized world. When the average person, and indeed when most Wall Street analysts and institutional fund managers think about silver, they do not think about the physical metal. They do not picture a dense, brilliantly reflective element pulled from the deep crust of the earth by human hands. They do not think of the sweat, the diesel, the massive machinery, and the sheer geological rarity required to produce a single ounce. Instead, they think about a ticker symbol blinking on a monitor. They think about derivatives, futures contracts, options chains, and exchange-traded funds like the SLV. They think entirely in terms of paper and digital entries. For decades, the global silver market has operated on a fractional reserve basis, functioning almost exactly like our fragile banking system. For every 1 ounce of real physical silver sitting in a secured London Bullion Market Association vault or a COMEX depository in New York, there are multiple, sometimes dozens of paper claims traded back and forth by speculators, hedge funds, and algorithmic trading bots in fractions of a microsecond. As long as everyone remains perfectly content trading the paper illusions, the system works flawlessly. The paper price can be managed, suppressed, and controlled by massive institutions, dumping millions of ounces of synthetic silver onto the market to trigger stop losses and wash out the retail speculators. But this deeply entrenched system possesses one fatal, inescapable flaw. It relies entirely on the absolute, unwavering assumption that the buyers of these digital contracts will never, ever ask for the physical metal to be delivered. But what happens when the narrative fractures? What happens when the industrial behemoths, the sovereign nations of the East, and the awakened retail investors finally realize that there are 10 claims for every single ounce of silver actually left in the vault? What happens when everyone rushes the exit door at the exact same moment, demanding their physical property, only to find the vault is empty? My friends, we are no longer sitting around asking, what happens if? We are watching it happen live, in real time, right in front of our eyes. Let us strip away the emotion for a moment and look at the cold, hard, undeniable mathematics. If you look at the Silver Institute's World Silver Survey, released just last month in April 2026, the global silver market is currently staring down the barrel of its 6th consecutive year of a massive structural supply deficit. For those unfamiliar with the macroeconomic terminology, A structural deficit means that the world is fundamentally, continuously consuming more physical silver than the entire global mining industry can pull out of the ground, combined with everything the recycling industry can recover. In 2023, the deficit was severe. In 2024, the shortfall deepened further, violently draining above-ground stockpiles. In 2025, the panic began to set in behind closed doors. And now, in 2026, conservative projections indicate a staggering, record-breaking deficit of over 215 million ounces. Even the most bearish, mainstream estimates from major bullion banks, institutions that historically have a vested interest in downplaying precious metal shortages, are forced to admit that we are catastrophically short this year. Think about what that actually means on a human level. Think about the gravity of that statistic. Every single day, for 6 straight years, the world has been forced to raid its savings account of above-ground silver just to keep the lights on, the factories running, the hospitals operating, and the global supply chains moving. You cannot run a deficit forever. Eventually, you run out of savings. Eventually, the broom hits the bare concrete floor of the vault. The buffer that protected the market from price explosions is gone. But what exactly is consuming all of this metal? Where is it all going? To comprehend why this deficit has transformed from a temporary, cyclical issue into a permanent, structural nightmare, we have to look at the unique, almost schizophrenic nature of silver itself. Silver is a monetary paradox. It is a dual-headed beast. On one hand, it is a monetary safe haven, recognized and sought after for over 5,000 years as a sovereign store of value. It is the money of the people. On the other hand, it is the single most critical, indispensable industrial metal on the periodic table. It is the absolute best conductor of electricity known to science. It is the best conductor of heat. It is the most reflective element in existence. Because of these unique atomic properties, it cannot be easily substituted. If you try to replace silver with copper or aluminum in high-tech applications, your devices overheat, they fail, or they simply require far too much space. Right now, as we speak, silver is being completely devoured by 3 unstoppable macroeconomic megatrends. If you blink, you will miss the greatest wealth transfer in modern history. First, we have the green energy revolution. The relentless, politically mandated push for renewable energy has triggered an insatiable, parabolic appetite for silver, specifically in the realm of photovoltaics, solar panels. As governments worldwide enforce strict net zero mandates, the construction of massive, continent-spanning solar farms has exploded. Every single modern solar panel requires a specialized paste made of highly refined silver to capture and conduct the electrons generated by the sun. 10 years ago, the solar industry was a blip on the radar for silver demand. Today, it is eating up a massive, ever-growing double-digit percentage of total global mine supply. And I know what the skeptics are saying. They say, John, solar manufacturers are thrifting. They are learning to use less silver per panel. Yes, that is technically true, but the sheer astronomical volume of new solar installations being deployed globally is completely, utterly overwhelming those microscopic efficiency gains. We are building solar capacity at a rate that defies historical precedent, and every gigawatt of that power requires physical silver. Second, we have the artificial intelligence boom. In the last 36 months, the world has fundamentally transformed. Artificial intelligence is no longer just a Silicon Valley buzzword, it is a global arms race. It is the new Manhattan Project. But AI does not run on thin air. It does not exist in the cloud. The cloud is just someone else's computer. AI runs on massive, hyperscale server clusters housed in colossal, energy-guzzling data centers. In late 2025, a critical engineering report circulated among hardware manufacturers that revealed a shocking truth. These next-generation AI data centers require up to 3 times the physical silver content of traditional data centers. Why? Because the advanced microchips and neural processing units powering AI run incredibly, dangerously hot. They require significant amounts of silver in chip attachment, thermal interface materials, and advanced heat dissipation systems just to prevent them from literally melting down under the immense computational load. The AI revolution, the very future of human technology, is literally being built on a physical foundation of silver. And third, we have the military and aerospace complex. This is the demand driver that governments desperately want to keep quiet. As global geopolitical tensions have boiled over in recent years, The production of advanced military hardware has skyrocketed. Cruise missiles, smart bombs, nuclear submarines, advanced radar systems, autonomous drone swarms, and low Earth orbit satellite constellations. All of them rely heavily, dependently, on silver for their complex electronics, fail-safe mechanisms, and precision guidance systems. This is what economists call perfectly inelastic demand. A defense contractor building a state-of-the-art $2 million hypersonic missile does not care if the silver inside its guidance system costs $30 an ounce, $130 an ounce, or $500 an ounce. They will buy it at absolutely any price, because without those few ounces of silver, the $2 million weapon is nothing but a heavy, useless tube of metal. These massive global industries are acting as black holes for silver. Once the metal goes into a solar panel baking in the Nevada desert, an AI server rack in a secure facility, or a cruise missile detonating on a battlefield, it is effectively gone forever. It is consumed in such tiny, dispersed quantities that recycling it is economically and chemically impossible. It ends up in a landfill, or it is blown to dust. It never, ever returns to the global inventory. Hold on to that thought, because the real shocker is hiding in plain sight in the very institutions designed to protect the market. If the demand is so high and the supply is so short, how on earth has the price not already stabilized at $200 or $300 an ounce? The answer lies in the deeply opaque vaults of the London Bullion Market Association and the Commodity Exchange in New York. For years, the price managers have been using the vast inventories in these vaults to artificially suppress the price, dumping paper contracts into the market to wash out the speculators and maintain the illusion of a strong fiat dollar. But their ammunition is finally running dry. Let me take you back to a moment that changed the trajectory of the financial world forever. October 2025. In October of last year, the silver market experienced a massive, unprecedented physical liquidity squeeze. The free float of silver in London, meaning the metal actually available for day-to-day trading, leasing, and delivery, completely unencumbered by exchange-traded funds or private family office allocations, plummeted to record, terrifying lows. Suddenly, industrial users who needed physical metal to keep their manufacturing lines open couldn't find it. The market entered a state of quiet panic. The cost to borrow physical silver, known in the industry as the lease rate, normally hovers at around a fraction of 1%. In October 2025, that lease rate violently, inexplicably spiked to a mind-bending 39%. Let that reality sink into your bones for a moment. A massive industrial player was willing to pay a 39% annualized premium just to borrow a bar of silver, because buying it outright in the physical market was mathematically impossible at that moment. A market that had felt perfectly well supplied for a decade had suddenly, violently become a desert. This acute physical stress is exactly what drove silver prices to their all-time high of over $121 an ounce just a few months later in January 2026. And while the paper price has currently been managed, pulled back, and consolidated around the $78 to $80 mark here in May 2026, the underlying illness has absolutely not been cured. The patient is still bleeding internally. Look at the COMEX today. As of this week, there are roughly 80 million ounces of registered silver in the COMEX vaults. Registered silver is the specific classification of metal actually available to fulfill delivery demands from futures contracts. Now, 80 million ounces might sound like a massive amount of wealth to a retail investor, but in global macroeconomic terms, it is a rounding error. It is pocket change. It is barely enough to cover a few short months of the global deficit. Worse yet, the paper leverage remains obscenely, criminally high. Today, the paper-to-physical ratio is sitting at roughly 6.4 to 1. That means for every 1 ounce of deliverable silver sitting in the vault, there are over 6 paper claims expecting it. The delivery coverage ratio is in the absolute danger zone. If even a fraction of the paper contract holders wake up tomorrow morning, look at the geopolitical landscape, and say, actually, I don't want cash settlement in depreciating fiat currency. Put the physical metal on an armored truck and send it to my private vault. The COMEX defaults. It is not a conspiracy theory, it is a mathematical certainty. But what I am about to tell you next is the piece of the puzzle that Wall Street prays you never figure out. Who exactly is taking the metal? Who is orchestrating this silent drain? The Western retail investor, the everyday person buying a tube of Silver Eagles, is only a tiny fraction of the story. The real silent tsunami is happening on a massive, sovereign scale. We are currently witnessing one of the greatest, most ruthless transfers of wealth in human history, as the physical metal flows continuously out of Western vaults and directly into Eastern hands. The BRICS nations and the broader emerging markets have realized that the Western fiat currency system, backed by nothing but trillions in unpayable debt and empty political promises, is reaching its inevitable mathematical conclusion. They are actively front-running the collapse of the dollar hegemony by quietly, methodically draining the physical commodity markets. Take a look at what happened just months ago in early 2026. Trade data revealed a shocking anomaly. A single country, Turkey, imported over 20 million ounces of physical silver in just 60 days. In 2 months, one mid-sized economy absorbed the equivalent of 25% of the entire COMEX registered inventory. They are bypassing the paper games on the Western exchanges and demanding physical, heavy delivery. And they are absolutely not alone. China and India have been relentlessly vacuuming up global silver supplies. Last year, India's silver coin and bar demand absolutely exploded as millions of citizens sought to protect their generational wealth from rampant inflation and currency debasement. The East understands a fundamental historical truth that the hyper-financialized West has foolishly forgotten. He who holds the gold makes the rules, but he who holds the silver controls the technology, the industry, and the very future of the global economy. When sovereign nations, central banks, and billions of Eastern citizens begin fiercely competing with industrial powerhouses like Tesla, Apple, and Nvidia for a rapidly shrinking pile of physical silver, the paper price mechanism will completely break. It will shatter into a million pieces, and true price discovery will finally occur. At this point, a traditional, mainstream Keynesian economist would interrupt me and say, "John, you are completely forgetting the most basic law of supply and demand. It is Economics 101. If the price of silver goes up, the mining companies will simply mine more of it, the supply will dramatically increase, and this supposed deficit will vanish overnight." That is exactly what a university textbook tells you. But university textbooks do not run complex multi-billion-dollar mining operations in the real world. The global silver supply is highly, aggressively inelastic. You cannot just flip a switch and produce more silver. Why? Because nearly 75 to 80% of all the silver mined in the entire world is not mined on purpose. It is a byproduct. It is found completely accidentally while mining for base industrial metals like copper, lead, and zinc. If the price of silver doubles or triples tomorrow morning, a massive copper mining conglomerate operating in Chile or a zinc mine in Peru is not going to fundamentally alter their billion-dollar operational plans, hire thousands of new workers, and dig double the amount of dirt just to get a few extra ounces of byproduct silver. Their operations, their margins, and their schedules are dictated entirely by the economics of copper and zinc, not silver. As for the primary silver mines, the rare companies that actually focus their entire operation on digging for pure silver, they have been brutally starved of capital for over a decade. Institutional underinvestment, crushing ESG environmental regulations, geopolitical instability and resource nationalism in major producing regions like Mexico and Peru, and rapidly declining ore grades mean that bringing a new silver mine online from discovery to production takes 10 to 15 years. Let me repeat that, 10 to 15 years. Even if the price of silver hits $200, $300, or $500 an ounce tomorrow, it will take over a decade for any meaningful, needle-moving new supply to hit the market. The ore grades, the amount of silver yielded per ton of earth moved, have plummeted. 100 years ago, miners were pulling out 50 ounces of silver per ton of rock. Today, they are lucky to get 5. We are trapped in a vicious supply bottleneck of our own making. Global mine production has effectively been flat to declining since it peaked way back in 2016. We have reached peak silver. The earth is simply not giving it up like it used to, and the cost of diesel, labor, and machinery required to extract it is skyrocketing due to inflation. So, as we look at this perfect storm of a 6-year structural deficit, exploding industrial and military demand, vanishing vault inventories, and a completely inelastic mining supply, you have to ask yourself a deeply personal question. What does this all mean for you? What does this mean for your family, for your future security? We are living in an era of massive historical consequence. The paper illusions and financial engineering that have propped up our economic systems for the last 40 years are burning away, exposing the hard, physical reality underneath. The silent silver tsunami is no longer a fringe theory discussed on internet message boards. It is a verifiable, statistical fact reported by the very institutions that govern the global markets. When the 215 million ounce deficit finally hits the immovable wall of physical reality, we will see a price discovery event unlike anything in the history of capital markets. The extreme volatility we are currently seeing, the wild, heart-stopping swings between $80 and $120, is just the structural foundation cracking before the entire house falls down. When the industrial giants realize they cannot source the physical metal they absolutely need to fulfill their multi-billion-dollar government and defense contracts, they will not be buying paper futures on the COMEX. They will be buying physical metal directly from refiners and private vaults at absolutely any price necessary, bypassing the traditional exchanges entirely. When the retail investor finally wakes up, looks at the purchasing power of their currency collapsing at the grocery store, and tries to trade their evaporating fiat for a tangible, historical store of value, they will find that the dealer shelves are completely, utterly bare. The premiums on physical coins and bars will detach completely from the manipulated spot price, just as they have already started to do in major hubs around the world. You must look in the mirror and decide. When the music finally stops playing, where do you want your life's labor and wealth parked? Do you want it in a digital blip on a screen, backed by the empty promises of a bankrupt government and a central bank that can print trillions at the push of a button? Or do you want it in a tangible, irreplaceable, industrially critical asset that has been universally recognized as real money for 5 millennia? The window of opportunity to position yourself ahead of this wave is rapidly closing. The global inventories are vanishing, drained by Eastern sovereign nations, consumed by the insatiable heat of artificial intelligence, and locked away forever in massive solar energy initiatives. Once the COMEX breaks, once the LBMA is drained of its free float entirely, the era of cheap, accessible silver will be closed forever. We will enter an entirely new economic paradigm, one where the physical possession of real, tangible assets will be the only true measure of wealth and freedom. This is the stark reality they will not tell you on mainstream financial television. This is the truth purposefully hidden beneath layers of complex financial jargon, algorithmic market manipulation, and geopolitical smoke and mirrors. But here, on this channel, we see the board clearly. We do not get distracted by the noise. We read the raw data. We track the physical metal. We understand the history of money. Thank you for giving me your time and your focus today. I know these macroeconomic topics can be heavy, and sometimes they can be frightening. But being early, being educated, and being prepared is the absolute only way to protect everything you and your family have worked so hard to build. If you found deep value in this analysis, please, I urge you to share this video with someone you care about. As I mentioned at the very beginning of this broadcast, the algorithms that run this platform do not want this kind of unfiltered, systemic truth reaching the masses. They prefer you stay distracted. Please hit the like button, subscribe to the channel, and turn on the notification bell so you never miss a critical market update during these volatile times. Let me know down in the comments below. Do you currently hold physical silver in your possession? And where do you honestly see the true physical price heading by the end of this chaotic year in 2026? I love all of you, my subscribers, for your relentless support and open minds. You are the reason I dig into these numbers and expose these realities every single day. Stay vigilant, stay fiercely educated, and above all else in this digital illusion of a world, stay physical. This is John A.G. I'll see you in the next one.